The AI stock boom has met its latest reality check. For 3 years, investors chased anything connected to artificial intelligence. Now they are asking the harder question. What if AI keeps improving, but the companies funding it never earn enough to justify the spending? On July 17th, a global technology sell-off gathered pace, and this time, the damage spread across the entire AI supply chain. This is the Global Ledger, a premium investment, business and financial intelligence channel. If you want to understand more about AI and technology disruptions and their impact on global markets, please subscribe. The fear is not that AI will fail. The fear is that the market has already paid too much for success. Taiwan's TAIEX plunged 6.5%, its worst day since April 2025. TSMC, the world's largest AI chip foundry, fell 7.3% despite strong results. Japan's Nikkei entered correction territory, while SoftBank, widely treated by investors as an OpenAI proxy, lost 9%. In China, the chip-heavy Star 50 fell more than 5%, showing that the pressure was not limited to Western AI stocks. In Europe, semiconductor equipment stocks also came under pressure, with ASM International and AXTRON both dropping more than 4%. Then the pressure reached America. Nasdaq 100 futures fell as much as 2%, and Nvidia declined 2.6% in early trading. Investors were selling chip makers, equipment suppliers, optical companies, and power-related stocks across the AI supply chain. One trigger was Kimi K3, a powerful new model from Chinese startup Moonshot AI. Moonshot says Kimi K3 can compete with leading models from OpenAI and Anthropic, while offering substantially better economics. That revived memories of the DeepSeek moment in early 2025, when an efficient Chinese model challenged the idea that frontier AI would always require ever larger quantities of the most expensive chips. The fear is straightforward. If capable models become cheaper and more efficient, customers may reduce reliance on costly Western systems. That could weaken revenue growth for AI developers, reduce spending of so-called hyperscalers such as Google and Amazon, and eventually lower demand for advanced chips. Chinese competition is also becoming more intense. Moonshot Hong Kong-listed rival Z.AI plunged 28%, while Minimax lost 16%. Cheaper, faster innovation threatens AI companies everywhere, not only in the United States. China was not the only cause. AI trades had become crowded, and valuations were stretched. Before the latest fall, TSMC was still nearly 50% higher for the year. That left little room for disappointment. Even after strong results and higher planned investment, investors focused on rising equipment costs, margin pressure, and whether the industry is spending too much. TSMC lifted planned 2026 investment from $60 billion to $64 billion. A huge commitment, even for the most important chipmaker in the world. When capital spending rises this fast, investors eventually ask who earns the return and who absorbs the cost. Memory chip producers faced another threat. Samsung Electronics and SK Hynix had already fallen about 40% from their June records. On more about the memory chip stock frenzy, we have produced another video, The Semiconductor Supercycle Investors, talking about. If you want to watch the video, click the link at the top right corner. New Chinese capacity could create oversupply and depress prices in parts of the memory market. For investors, that matters, because memory has always been vulnerable to oversupply, price declines, and brutal margin compression. Geopolitical tension added another layer of pressure, as latest conflicts involving the United States and Iran pushed oil toward $85 a barrel. Higher oil threatens inflation, corporate margins, and consumer demand. Exactly the kind of macro-risk expensive growth stocks do not want. And yet, the AI story is not over. TSMC's underlying results were robust, and semiconductor earnings momentum remains healthy. Hyperscalers continue committing hundreds of billions of dollars to data centers and AI infrastructure. Greater model efficiency may expand adoption. Cheaper inference can bring more users, applications, and businesses into the market. In technology, lower costs often do not destroy demand, they unlock it. China's progress does not necessarily destroy the AI investment case. It may broaden and accelerate global competition. But investors must separate technological progress from stock market returns. Revolutionary technologies can change the world and still produce terrible returns for investors who overpay. The warning signs already appeared before this sell-off. The Magnificent 7 index fell 1.9% in the first half of 2026, badly trailing the S&P 500's 9.6% gain. After such extraordinary gains, many AI stocks had little room for disappointment. The most likely outcome may not be a clean return to euphoria. It may be consolidation or a deeper correction. AI may still transform the world, but the market is now learning an old lesson. A great technology is not always a great stock at any price. Tell us in the comments, is this just a healthy AI correction or the beginning of a much deeper unwind? Until next time, follow the intelligence.